Imagine this for a moment. You open your investment app, expecting to see progress. Instead, you're hit with a wall of red. Every number is lower than yesterday. Every chart slopes downward. You refresh once, it gets worse. You refresh again, still red. At this point, your heart sinks a little and a quiet thought creeps in. Did I make a huge mistake? You turn on the news, hoping for reassurance, but instead you hear words like crash, recession, slowdown, correction, uncertainty. Analysts argue, headlines scream, social media panics. Everyone suddenly has an opinion, and none of them sound comforting. Now you're stuck. Do you sell before things fall even more? Do you buy more because people say this is an opportunity? Do you do nothing and just hope the market fixes itself? Here's the strange part, most people never tell you. Moments like this are exactly when some people quietly get rich. Not during the hype, not when everyone feels confident, but during fear, during chaos, during crashes. So the real question isn't, why is the market falling? The real question is, do you understand what's happening well enough to survive it and maybe even benefit from it? Because if you don't, this exact moment could cost you years of progress. But if you do, it could completely change your financial future. Before making any decision, before touching the buy or sell button, we need to slow down and understand what's actually going on. Why do stock markets crash in the first place? Is this normal behavior or something dangerous? How do experienced investors react when prices collapse? And why do some people come out richer while others lose everything? By the end of this video, you'll see market crashes very differently, and that shift in perspective alone can save you a lot of money. Let's start with the basics. A stock market crash happens when prices fall sharply in a short period of time. It feels sudden and violent, like the ground disappearing beneath your feet. But here's the truth. Most crashes are not random. They are the result of pressure building quietly over time until something finally breaks. One of the most common reasons markets crash is unrealistic optimism. This is what people usually call a bubble. A bubble forms when stock prices rise far beyond what companies are actually worth. At first, the growth looks justified. New technology, exciting ideas, strong stories. But eventually, prices stop reflecting reality and start reflecting emotion. Investors begin buying not because the business is strong, but because prices keep going up. Fear of missing out takes over. Everyone wants in. Social media amplifies the excitement. Stories of quick profits spread faster than facts. And the higher prices go, the more confident people become that they can't possibly fall. Until they do. At some point, investors realize the numbers don't make sense anymore. Profits don't justify the valuations. Growth slows. Expectations are missed. Confidence cracks. Once selling starts, fear spreads even faster than excitement ever did. Everyone rushes for the exit at the same time, and prices collapse. This exact pattern played out during the dot-com era. In the late 1990s and early 2000s, the internet was revolutionary. Investors believed it would change everything, and they weren't wrong, but they assumed every internet company would succeed. Money flooded into businesses with no profits, no clear plans, and sometimes no real product. Stock prices exploded simply because of hype. When reality finally caught up, the crash was brutal. Massive losses followed, trillions of dollars vanished, and many investors who bought near the top never emotionally recovered from it. But here's the part people forget. The internet didn't fail. Strong companies survived. Those who understood that difference and stayed patient eventually benefited. Another major cause of crashes is economic pressure. The stock market does not exist in isolation. It reflects what's happening in the real world. When inflation rises, everyday life becomes more expensive. Groceries cost more. Rent goes up. Energy bills increase. People naturally spend less. When consumers spend less, businesses earn less. When businesses earn less, investors expect weaker future profits. And when expectations fall, stock prices follow. If this slowdown spreads across many industries, the entire economy can lose momentum. That's when recession fears start to appear. Government and central bank decisions can make this pressure stronger. When inflation gets out of control, central banks often raise interest rates to slow things down. Higher interest rates make borrowing more expensive, businesses delay expansion, consumers take fewer loans, spending slows even further. The market reacts quickly, often before the effects are fully felt in the economy. That's why interest rate announcements can move markets instantly. Investors aren't reacting to today, they're reacting to what they believe tomorrow will look like. But sometimes, though, markets crash for reasons nobody expects. These are known as black swan events, rare, unpredictable shocks that change everything overnight. Wars, pandemics, sudden financial scandals, global crises. These events don't slowly build up, they hit fast, creating fear and uncertainty. The COVID-19 pandemic is a perfect example. Within weeks, global markets plunged as economies shut down. Investors weren't selling because companies suddenly became bad businesses. They were selling because nobody knew what would happen next. Fear moves markets faster than logic ever can. Now, here's the key question. If crashes happen for all these reasons, are they normal, or should you be genuinely worried every time the market falls? The answer might surprise you. Market declines are not just normal, they are essential. The stock market does not move upward in a straight line. It moves in cycles. Growth, slowdown, decline, recovery, over and over. Small drops happen regularly and are simply part of market movement. Larger declines happen less often, but still appear consistently throughout history. Even major crashes, while rare, have occurred many times before, and every single time the market eventually recovered. Look at history. Oil crises, financial crises, tech crashes, pandemics. Each one felt like the end of the world at the time. Yet over the long run, markets not only recovered but reached new highs. The people who suffered the most were usually not those who invested, but those who panicked. They sold when fear was highest and prices were lowest. Meanwhile, those who stayed patient, stayed invested, and focused on quality were rewarded over time. Of course, some people worry that one day the market won't recover. That fear isn't completely irrational, but context matters. As long as businesses continue operating, people continue working, and governments act to stabilize the system, recoveries are very likely, especially in large and stable economies. True financial collapse, where banks fail entirely and money becomes inaccessible, is extremely rare, and even in those rare cases, panic decisions rarely help. Now, let's talk about what really matters. How do you survive a crash, and how do some people actually profit from it? A market crash feels like the worst possible time to invest. Emotionally, everything tells you to run, but logically, crashes are when prices are lowest and opportunities are greatest. The difference between success and failure often comes down to behavior, not intelligence. One of the biggest mistakes investors make during crashes is panic selling. Watching your portfolio drop triggers a natural fear response. Selling feels like relief, but selling during fear often locks in losses permanently. If the business behind the stock is still strong, the price has a chance to recover. Selling removes that possibility. Another mistake is trying to perfectly time the bottom. Everyone wants to buy at the lowest price, but almost nobody can consistently predict it. Waiting for the perfect moment often means missing the recovery entirely. Buying too early feels painful, but buying never often costs more in the long run. Consistent investing over time reduces this problem. It removes emotion from the decision-making process and allows you to benefit from lower prices without needing perfect timing. A third mistake is buying weak companies simply because they look cheap. A falling price doesn't automatically mean value. Some companies fall because their business is broken. Those stocks may never recover. That's why quality matters more than price. Strong companies tend to survive downturns. They have solid balance sheets, real earnings, competitive advantages, and proven leadership. During crashes, these businesses often fall along with everything else, not because they're bad, but because fear affects the entire market. This is where long-term wealth is often built, not by chasing hype, not by reacting emotionally, but by understanding what you own and why you own it. Market crashes are uncomfortable. They test patience, discipline, and emotional control. But history sends a clear message. Crashes don't destroy wealth. Poor decisions do. If you stay calm when others panic, if you focus on strong businesses instead of headlines,